We are on video number 3. Speak a little bit about what our zones are based on. Why do our zones work? Why are they effective? And our zones are created using a unique and proprietary methodology in a way that utilizes supply and demand information that the market provides to us. Our zones are based on what occurred in the order flow the last time the market was in these areas, and utilizing these zones as support and resistance as a tool in your trading arsenal will help you identify high probability areas for trade opportunities. Now, I want to explain a little bit about what makes our zones tick. Why do they have a high probability of causing a reaction in price? And in order to do this, I want you to think about our zones as representing pockets of orders, if you will, in the market. Buy orders and sell orders. Now, I'm going to give you an analogy. And analogies are helpful in inspiring those aha moments that we all encounter when learning about something new. Now, again, the last time the market was in these zones, there was a battle going on between supply and demand. So there are a few groups of traders, different classifications of traders, if you will, that are going to be looking to trade in these areas when the market comes back into them. These areas, these zones represent areas of value to different traders with different agendas on different time frames for different reasons. But let's talk about a few of these examples, and I'm going to give you an analogy. If you were to find a used car in the classifieds, for example, a Corvette. I don't know exact prices for Corvettes, so I'm just going to throw out some random numbers. But let's say you saw a 1990 Corvette for say $8,000 in the paper, and you were able to buy that Corvette, turn around and resell it for a profit of say $3,000. So a week goes by, you're looking at the paper again, you see another Corvette, same year, same price, $8,000. You'd be all over that. You'd be looking to be able to buy that Corvette and do the same trade again, if you will. Look to buy that Corvette for $8,000, turn around and sell it and book a profit. Well, it's the same way in the market. There are traders that conduct business in certain areas of the market. The market does what they were looking for it to do from that point on, so they make a profit in their trade. When the market comes back into that area, they're going to look to repeat and conduct that trade again because that zone represents value to them. So the last time the market was here, whenever this was, whether it was an hour ago or whether it was a week ago, traders got long, the market bounced to the upside, and they were able to book a profit. Now the market's back into this area, so they're going to look at this area in the same manner. They're going to look to take advantage of this area being value, as long as the context of the market hasn't changed, as long as the conditions of the market hasn't changed, as long as there's no news affecting the market or anything else. Now, another group of traders that's going to be looking to buy in here are traders who were able to get filled on some of their orders here, but only partially, and they're still working some inventory here. So as the market comes back down into this area, they're looking to execute again and take advantage of the fact that they have another opportunity to work inventory. Maybe the market bounced a little bit, they took some profit on a partial position, now the market's coming back into that area, they have more inventory to work. And we're talking about smart money traders, big money traders, working hundreds, maybe thousands of contracts in a certain area. We're not talking about one lots and two lots. So sometimes it's not easy for them to get filled in a certain area, and they want to be able to complete the inventory in that area. So when the market comes back in, they're going to look to buy, which causes demand to come back into that area. Another group of traders, third group of traders, are anybody, as the market was in this area previously, that might have sold in this area. Okay, now, since then, the market rallied, so those traders were taking heat. Now the market comes back down into that same area, gives them the opportunity to get out of their trade at break even, to scratch out. A lot of those traders are going to look to take advantage of that opportunity. What are they going to do here to get out of their short trades? They're going to look to be buyers. Right, so that's going to produce demand in this area. If you have to cover a short, you have to buy to cover that short. So that's going to create additional demand in that area. In order to trade correctly, you have to put yourself in the shoes of someone who might be looking to trade in that area and think about why is somebody willing to do business in this area? Why do they perceive this area to be valued? And when you stop and think about the market in those terms, and most retail traders don't, they don't stop to think about what's really causing the market to move and to stop and to change direction. It's based on the order flow. It's based on the supply and demand conditions. So for us, valid analysis equals valid trading, right? So it's, again, it comes back to, and you're going to hear us say this over and over and over again because this is the foundation to our trading business. It's about identifying important zones of price in the market where we want to do business. It's about identifying trades and opportunities that make good business sense. We're not in the prediction business, guys. We don't put that pressure on ourselves to predict where the market's going to go. Instead, we're providing a consistent and objective view of the markets using an if-then approach based solely on supply and demand-based principles. And of course, having an opinion about market condition, having a bias is a necessary component of trading. And through our consistent and objective analysis, we're always looking to define our context. You know, where did the market come from? You know, are we on the tail end of a 3-day rally? Has the market rallied 60 points? You know, or has the market rallied 5 points and is selling off a little bit? You know, these are different types of context. Is there news affecting the market? Is there an outside influence? Is the euro rallying hard because of rumors coming over, you know, in the eurozone, which might in turn affect the S&Ps? These are all different things that form the context. But within our consistent and objective analysis, we're always looking to define that context. We're looking for areas of opportunity, price zones where we want to do business. And our goal as traders is to increase our edge by narrowing our focus to trading only markets and market levels that offer the best opportunity to us. And this, guys, is of major importance, crucial to your long-term success as a trader. You need to learn to distinguish between opportunity and random noise in the market and limit your trading to the best of the opportunities that you come across. And at the same time, try to use trade location to your advantage. And that's another big way that we use our zones to obtain optimum trade location. Good trade location, no matter what time frame you're trading, provides you with an asymmetric opportunity because the risk is relatively small, whereas the reward can be relatively large. So trade location, constant theme in our trading strategy. In our next video, we're going to talk a little bit about how to use our zones, how to utilize them correctly.